Hey everyone, I have a quick warning for tax season. For the second time this year, I've seen a 1099 that was incorrect. And in both cases, it would have meant that my client would have paid higher taxes and higher Medicare premiums if it wouldn't have been caught. So I don't want this to happen to you, so here's what you need to look for. There are several different types of 1099s that are issued, and you need to check all of them closely. But today, I'm talking about the 1099s that you'd typically receive from your investment accounts. These would generally be a 1099 DIV, a 1099 INT, a 1099R, or the 1099B, and it wouldn't be all that uncommon to receive all of these. And you may even receive a consolidated 1099C that rolls several of those into one document. Now, I don't want to go into an in-depth analysis of these forms, but for this to make sense, it's important to cover a quick description of what each of these forms do. The 1099 DIV reports dividend income and capital gains distributions. This is not capital gains from the sale of investments, just distributions, and I'll cover that more in a moment. The 1099 INT reports any interest over $10 that's been paid. This could be from savings accounts, CDs, or individual bonds. The 1099R reports distributions from retirement accounts. And the 1099B reports capital gains and losses from the sale of investments like stocks, mutual funds, or other securities during the tax year. If you have IRAs and taxable investment accounts, it's likely that you're receiving all of these forms. These may be coming to you in the mail, but you also have to watch for the 1099s that are emailed to you. It's easy to forget that you opted into email forms, and if it's a company that routinely bombards you with email and then sends your 1099 via email, you may miss it. So this means that it's really, really important to keep up with who should and should not be sending you a 1099, because these companies that send you a 1099 are also sending a copy to the IRS. So not using them in your tax filing is simply not an option. The IRS has a matching system in place that can nearly instantly match 1099s they've received from the issuers with the 1099s in your tax return. And if one is missing, you're going to hear about it, and then you're going to have to get it fixed. But just watching for these 1099s and putting them in a folder to turn over to your tax person is not a good idea. You need to carefully study these and make sure the information is correct. At the large financial institutions, the 1099 process is mostly automated. And this generally means that the 1099s that come out are correct. But there are still areas where mistakes can come up, and these mistakes can be costly. For example, one of the incorrect 1099s we've seen so far is where someone sold a mutual fund for the explicit purpose of not being included on the annual distribution from the mutual fund company. Now, these distributions are nasty things that can hand you a big tax bill that's completely out of your control. This is going to be a big deal this year, and it's going to catch a lot of investors by surprise. Now, it's only an issue for your taxable accounts. If all you have are IRA and other tax-deferred retirement accounts, you don't need to worry about this. And specifically, it's your taxable accounts that hold packaged products like mutual funds and ETFs. Now, the structure between those two is very similar. It's a package of stocks or bonds that you mutually own with other investors. This becomes an issue when that mutually owned investment has sold investments within the fund at a gain. And because you are in a mutual fund that is mutually owned, you get to pay your mutual share of the tax on that gain. So, for example, assume your mutual fund bought XYZ stock in 1990 and then sold this position in 2021. If they sell this position at a gain, someone has to pay the tax on it. And that someone is the people who mutually own the fund at the time of the sale. So even if you bought it in October of 2021 and didn't get to participate in all that gain, you still get to pay your share of the tax on it. Now, the good thing is that every year the mutual fund companies publish their distributions along with the dates of record, and only the people who own the mutual fund on that date of record will receive the distributions. If you sell before that date, your share of the distribution is going to get passed along to someone else. If you want to see a video on an example of how this is impacting owners of Vanguard funds this year, check out this video by Joseph Hogue. I'll link it up down in the description. Anyway, I'm getting off track here. I could spend a lot more time talking about this one specific issue because there's a lot more to know, but let me get back on today's topic. So this client sold her mutual fund to avoid a big distribution. She sold it well before the cutoff date, and when she got her 1099s for the year, that distribution was included. This means that she had a capital gain for both the distribution and for the sale, and this gave her an extra $40,000 to report for income. Another example was a client with a 1099-R he received for his IRA transfer. Instead of marking it as a transfer, it was coded as a total distribution. This meant that using this 1099 would have given him a few $100,000 extra dollars of taxable income. Now, look, a mistake of that size would have probably been caught by the client or tax advisor. But what if the mistake only increases your taxable income by, say, $10,000? I can tell you that most of my clients would find that fluctuation normal and probably would never even question it. But what if that additional $10,000 in taxable income also triggered the IRMA? This is where Medicare premiums go up if your income exceeds certain limits. And it's not a phase-in, it's a cliff. So if your income exceeds the threshold limits by even $1, your Medicare premiums go up. And that first threshold bracket would increase your Part B premium by $68. So if you're married and both on Medicare, that would be an extra $136 per month in premiums. And that's in addition to the tax from the extra income. But the problems from a small increase in taxable income isn't only a potential issue for those with higher incomes. If your income isn't high enough where the IRMA could become an issue, you could still have the problem of the additional income pushing more of your Social Security into being included as taxable income. For example, take a couple who files jointly, and if they are collecting a total of $3,750 a month in Social Security benefits, they have a pension that's paying $1,000 per month, and then they take another $2,000 every month out of their retirement plan. This would result in a total tax at the end of the year of $2,785. Now, assume they had an additional $10,000 added to that taxable income from an incorrect, say, interest income report or distribution from a retirement plan. Well, in that case, their total tax would jump up to just over $5,000. That extra $10,000 in income would make their taxes nearly double. This is because that not only did they have to pay tax on the $10,000, but now the extra income pushed more of their Social Security into taxation. Without that erroneous $10,000 in income, their Social Security was only 40% taxable. And once you add that income, 60% of their Social Security income becomes countable as taxable. So these income mistakes can have an effect that reaches beyond just the tax on that incorrect income alone. Now, in our office, it's a built-in part of our client service calendar to check the 1099s that are issued by our custodians that we use. And if your advisor has any sort of process in place, they may do this as well. Just ask your financial advisor to check your 1099s and make sure everything seems to be correct. So what happens if you receive a 1099 and you know it's not correct? Well, you can usually ask the company that issued it to correct it. If it was a mistake, they can usually get this done fairly easily. But if the issuing firm refuses to correct it and the client has the documentation to show it's a mistake, your tax advisor can usually fix it with an adjustment. So when you finish watching this video today, go check your 1099s. Look at each of the boxes carefully and make sure nothing stands out that you didn't expect. When your tax advisor sends you a draft copy of your tax return, be sure to pay attention to the worksheet that compares your current income numbers to the years prior. There'll be a breakdown of your interest, capital gains, dividends, and a lot more. And if one of the numbers stand out as being much higher than the years prior, and there's not a reason for this, you need to dive in a little deeper. Now, down in the comments below, I'd love to hear your stories. Have you ever received a 1099 that was wrong? And if so, how did you fix it? I know I have a lot of tax advisors in my audience, so I'd like to hear your stories as well. Do you see these very often? And is there one reason you can point to as to why most 1099s are wrong? I can't wait to read your comments below. Thanks for watching.